A neighbour observes new stores opening in various towns, and the stock price continues to rise in the news. Simultaneously, television experts debate, leaving the average investor feeling late to the game and unqualified. This tension escalates because professional commentary, while sounding credible, often overlooks the insights consumers gain from personal experience. When inexperienced investors mimic tips without true understanding, they react impulsively instead of conducting meaningful research on businesses. This behaviour results in purchasing overhyped stocks at inflated prices while selling valuable holdings during standard market dips. The outcome is years of hard work yielding little progress, despite the fact that excellent investment opportunities can be identified early. In a workplace, employees notice a product quickly selling out, yet they fail to link it to deeper market research. At the same time, a newsletter endorses a different stock, prompting the office to invest without a solid strategy. This video will teach you how to scout locally, categorize stock types, and assess ideas using straightforward checklists. This video draws inspiration from One Up on Wall Street by Peter Lynch and John Rothchild, so be sure to subscribe for practical investing resources. The term dumb money refers to ordinary investors, but it only becomes dumb when it mindlessly follows experts without critical thought. The advantage lies in the fact that daily life reveals consumer demand, store foot traffic, and service quality ahead of analyst reports. Starting your research with observation allows you to discover opportunities early and avoid overpaying for a fully developed narrative. When tips trigger the process, purchases can be based on authority, leading to confusion during typical market fluctuations. A shopper spots pantyhose packaged in plastic eggs at grocery checkouts, increasing the frequency of purchases. This simple insight into product placement indicated a surge in sales, and later research linked the product to its parent company. This method values curiosity as the starting point, but it also necessitates confirming earnings potential, financial health, and competition before making purchases. The aim is not to be clever, but to cultivate repeatable observation alongside disciplined analysis, ensuring decisions are clear and justifiable. Write down one company you noticed this month, then identify what needs to improve for its earnings to grow over time. Next, compare that narrative with data and facts, and move on quickly if the evidence doesn't align. A 10-bagger is a stock that appreciates roughly tenfold, and the best investment opportunities often lie close to home. Workplaces and shopping areas reflect changes in expansion, inventory, and consumer demand before analysts notice. If early indicators of success emerge across many locations, a large number of observers can spot them long before professionals. This early awareness is crucial because later investors might end up paying a premium when the story becomes obvious and potential gains diminish. A retail chain opens multiple new stores, and employees, contractors, and customers all witness a rise in traffic over several months. When even one outstanding stock is added to a portfolio of average performers, the overall return can shift dramatically. The edge is not derived from insider gossip. It comes from recognizing genuine consumer adoption and then verifying if the company can sustain that momentum. This keeps focus on businesses that are easy to understand, rather than chasing after complex products wrapped in jargon. After identifying a potential investment, take the time to thoroughly understand its financials, competition, and growth trajectory, just as you would for any significant purchase. If the company's narrative holds up under scrutiny, keep an eye on store counts, margins, and earnings to ensure reality aligns with expectations. Once you've categorized a stock, your next task is to construct the earnings growth story that outlines the reasons for anticipated increases. This story should clearly explain what needs to occur for growth to happen, along with the major risks that could derail progress. Without a well-defined story, movements in stock prices seem like random signals, but they can deviate from fundamentals in the short term. When you have a story, a price drop prompts you to investigate further, while a price rise signals a need to understand the changes behind it. In a cyclical industry, a prolonged downturn can shift towards recovery when sales improve, inventories are cleared, and management trims excess capacity. The key takeaway is that successful investing relies more on understanding market cycles and preparation than on daily stock price changes broadcasted on television. Crafting a 2-minute explanation that a child can understand requires clarity and helps you avoid impulsive decisions based on catchy slogans. This process also simplifies monitoring, allowing you to revisit the story periodically as if you're hearing it for the first time. Before making an investment, write out your 2-minute pitch that includes what needs to unfold, what could potentially go wrong, and the key indicators you'll watch. If this structured approach resonates with you, consider subscribing for more resources that help keep your stock decisions balanced and thoughtful. Once the story is seamless, use concrete numbers to evaluate whether goals are realistic and if the company can withstand challenges. Focus your analysis on cash flow, debt levels, profit contributions from products, and the price-to-earnings ratio. A product might be popular, yet if it's too small to impact a major company, you need to assess its sales implications carefully. Overlooking the importance of scale can lead to disappointment, as excitement around a single product doesn't guarantee it will drive earnings meaningfully. A leading diaper brand may command the baby aisle, but if the parent company is vast, its earnings impact can be overwhelmed. In contrast, a smaller firm with a breakout product can transform its financial landscape, showcasing how the same market dynamics can yield different outcomes. Valuation is crucial because a company priced fairly usually has a price-to-earnings ratio comparable to its growth rate. When this ratio is significantly higher than growth expectations, even strong operational execution may leave shareholders stagnant for years. Utilize comprehensive sources to review debt and historical performance. Then compare growth metrics, valuation, and dividends within the stocks category. If the data contradicts your narrative, prioritize the facts over the story and seek a more straightforward investment opportunity. Before you compare stock tickers, conduct a mirror test to assess your own readiness and ability to hold investments long term. This test examines whether your fundamental needs are secure, whether you need the money in the near term, and if you can maintain patience in the investment. Lacking this self-assessment often leads investors to pursue unrealistic annual returns and abandon their plans after facing a disappointing year. A more practical outlook anticipates fluctuations, which keeps you focused on technique and committed to your investment strategy. An informed investor may purchase a stock after due diligence, only to see a change in policy hurt the business and lead to a loss in value. The lesson is to accept that occasional losses are part of the journey, because success often comes when 6 out of 10 investments meet expectations. Long-term success in investing is rooted in maintaining your strategy consistently through both prosperous and challenging times, rather than pursuing short-term predictions. Rather than selling based solely on price fluctuations, revisit the underlying narrative and adjust your portfolio based on solid fundamentals and valuation. Focus on a limited selection of stocks that you can effectively monitor, dedicating consistent time to in-depth research instead of being swayed by market noise. When your expectations align with reality and you actively track your investments, market downturns become uncomfortable, but manageable challenges in your investment journey. The true advantage lies in transforming everyday experiences into insightful research, turning investing into a disciplined practice rather than a gamble. A strategy built on careful observation, compelling narratives, and data will endure beyond the market's emotional swings that often lead to poor timing. Start by gaining a personal edge through diligent research and scouting for standout candidates where signs of success are clear and evident. Classify each stock, craft a concise 2-minute summary, and rigorously evaluate key metrics to confirm that the investment narrative remains intact. Over time, this approach minimizes the risk of overpaying, filters out misleading tips, and boosts your confidence in holding on to genuine winners for the long haul. It fosters a sense of calm as your progress is gauged by earnings and fundamentals rather than daily market fluctuations. Begin with one company that you can closely observe and establish a weekly routine for checking its performance against emerging facts. If the company's outlook shifts or its metrics show decline, act swiftly to replace it rather than defending an unproductive narrative. The market will always be noisy, but a simple, disciplined framework allows you to focus on what truly enhances your investment results. Stay committed to learning practical methods for identifying clear, understandable companies, thoroughly testing them, and practicing patience during market volatility.